And if you look at the trajectory of other industries that have used securitization, this is the beginning of something that I think will be an important part of capital structures of companies that are deploying fiber optic networks going forward.
That was Jim Stanley, Senior Vice President and Treasurer for Frontier Communications, regarding how he sees asset securitization playing a role in funding fiber network builds. Hi, I'm Jeff Johnston, and welcome to the All Day Digital Podcast, where we talk to industry executives and thought leaders to get their perspective on a wide range of factors shaping the communications industry. This podcast is brought to you by CoBank's Knowledge Exchange Group. With the recent rise in interest rates and tightening of credit conditions from major banks, companies are exploring alternative ways of raising capital. One option that is garnering increased interest in the communications market is the securitization of network assets and customer contracts. This type of financing vehicle enables companies to raise capital quickly from a wide range of investors. Given Jim's extensive expertise as Frontier's treasurer and the fact that Frontier recently raised capital with a securitization offering, we were eager to have him on to learn more about this alternative way of sourcing capital. So, without any further ado, pitter patter, let's hear what Jim has to say. Jim Stanley, welcome to the podcast. It is an absolute pleasure to have you with us here today.
Hey, Jeff, thanks a lot. Thanks for inviting me, and thanks for your support and CoBank's support as well through everything we're doing here at Frontier.
Absolutely. I'm glad we can be a part of it. Super excited to have you on the podcast here today. Want to talk about, I guess I would call it a different form of capital financing. I mean, different in terms of just pouring money from a commercial bank. But this whole notion of, I don't know if you call it asset-backed securities or securitization of assets. What is this kind of form of financing? If you could just kind of give us a high-level overview of what that structure is.
Yeah, sure, Jeff. It's a structure, asset-backed securities, or securitization, as it's being called, is something that is not new to the world of finance. It's been used for many years in oil and gas, rail cars, rental cars, jet leases, a number of different areas, and it's become more prevalent in digital infrastructure over the last decade, and most recently here in financing fiber optic networks. It's a technique that involves a structure, so a legal structure where you're taking valuable assets from the company, placing those assets into a newly formed special purpose entity that has bankruptcy remote characteristics, and allowing debt to be issued in that special purpose entity based on the net operating cash flows of those assets that you've dropped into the entity. So it's a way of isolating assets from the parent company. It's a way of attracting a different type of investor, which allows us to borrow costs at a higher level of leverage and a lower rate than we typically would typical bank debt or high yield debt.
So the notion of separating this structure from the parent company, I guess that reduces, risk for investors. And then I'm guessing it also gives you a more favorable interest rate as well. Is that a fair comment?
That's exactly right. So not only do you isolate these really valuable assets and put a focus on those assets, but the structure puts in place credit enhancing provisions such as liquidity reserves, cash traps, cash sweeps, and other things that are triggered to retain that cash for the purpose of maintaining the principal and interest payments that lowers the risk of the cash flows around those assets. When we do that, we get it rated, and we get it rated in separate tranches, and we get A, B, and C tranches, with the higher numerical being subordinated to the lower numerical tranches. And that allows us to invite in and attract investment grade lenders where we typically haven't been able to do that. Frontier has a corporate rating of BB-, and we've been able to rate the A tranche and the B tranche of our securitization as investment grades with an A rating on the A and a BBB on the B. So it allows us to attract more investors, ones that will allow us to have a lower interest rate on the blended product, as well as achieve a higher level of leverage on these really valuable assets that we put into the securitization entity.
Okay, that's great. That's great. We're all aware that interest rates have gone up a lot here in the last 18 months. There's concerns around the state of the economy, and commercial banks are starting to tighten up their lending standards. It's harder to get a mortgage if you're trying to buy a home. I mean, it seems like credit's just getting tighter. And then on top of that, of course, in the communications industry, we've got this kind of rush to everyone wants to plant their fiber flag first and build fiber in underserved areas. So there's a whole lot of momentum there, but then sort of the choking point could be access to capital. So kind of with that as a backdrop, as we think about, this particular structure from a capital financing strategic perspective, maybe just help us understand, is this so that you can raise capital quicker and cheaper than going through traditional forms given the tightening, or how you think companies think about that from a strategic perspective?
From our perspective, securitization is going to be one tool in the box of all of our capital structure. So we'll continue to have leverage loans, high yield bonds, as well as securitization going forward. But for an entity like ours that has a very long-lived asset, that has a sticky group of customers that will continue to pay if the product is what we know it is, a high-speed, very efficient, and very reliable network, it allows us to lower the cost of our build, lower the cost of our investment overall. But it is one market that we want to have that access to, so we can tap the securitization market or the high yield market or the leverage loan market when one or the other may have some difficulty. In this time when rates are rising on all of these products. And what we want to do is make sure that over time, if one of the markets were to shut down, we've got access to the other. It's an interesting world that we're in at Frontier, where we've been traditionally a high yield and leverage loan. Getting into securitization, we need to make sure we're preserving ratings, preserving the overall credit backdrop of the company as we're bringing this new product in that leverages some of our best assets at a real low rate.
Seems like a very prudent capital budgeting strategy to pulling on different levers that make the most sense for the company. So that's great to hear. So in terms of the assets that are backing up these securities, obviously fiber is clearly one of them. I mean, can you do customer contracts as well? Can you securitize those? Can you securitize DSL networks or HFC, or does it have to be, is it really better to do fiber and customer contracts with large corporations?
Different industries have done different things. So securitization can be morphed into different products. And when we looked at this for our application, what we wanted to do is be able to put something into that special purpose entity that could essentially be portable if there was a distress situation. So what we placed into our inaugural transaction that we closed in August was the entire network around our Dallas-Fort Worth area. That was primarily fiber optic. It's a fiber optic network that has been in place for years. It was one that Frontier acquired from Verizon and was started being developed in 2004. But it's the fiber optic network, including all of the cables, all of the network equipment, all of the facilities and infrastructure required to provide the internet and related services to customers. But it's also in that footprint, that geographic footprint, all of the work that we do with DSL network, which is a much smaller portion, and all of the work that we're doing not only to residential customers, but wholesale commercial customers as well. So we saw that taking a footprint was the best way to segregate those assets and give comfort that those assets could be something that the investors could look to as a backstop to support the principal and interest payments over time.
I mean, this seems like from the outside looking in a fairly complex thing to do. Maybe I'm mistaken with that. But I guess when you think about, obviously this was the right decision for Frontier, but is this the right decision for any type of communications company, be it small or large? I mean, how do you think this would sort of screen out for different companies that, whether it would or would not make sense?
Yeah, so I think it's something that as we get into the fiber optic space will become more and more accepted on the part of investors. I think we had good uptake in our transaction, and I think investors are becoming more and more knowledgeable about the space. The complexity has to be accepted by the investment community, which is happening. The structure is complex, and it is something for an operator like us, to get our head around the legal aspects of it, the regulatory aspects. All of that's complicated, as well as the operational aspects of being able to segregate customer payments, to be able to segregate operations and all of that. But with all of that being said, it is something that I believe can be executed in large companies and small companies as well. So there were a couple of transactions that took place in the private space before ours that were smaller in scale that I think were received very well. I think the technology, if I can call it that, for this structure is something that's applicable for fiber operators. It's applicable for Frontier specifically. It really depends on just the way the operator can put out those assets as resilient, sustainable, which they will be over time, and something that provide a good cash value given the ins and outs of the economy.
Let's just talk a little bit about the investors who are interested in buying up these tranches. I would imagine it's a wide sort of cast of characters, but if you can share with us, what you've seen and typically who is interested in these types of products.
Sure. So, and it varies by these tranches we talked about, the A, B, and C class. So within the A's, there's actually two different types of products. One is a term note that are the bonds that we sell, and one's a variable funding note, which is a floating rate instrument that is something that is drawn after closing based on the conditions of that note. So in the A's, the VFN is primarily banks and banks that would lend in oftentimes to traditional revolving lines of credit. In the A notes, the A bonds are fixed rate, which are typically insurance companies, institutional money managers, and to a lesser extent, some hedge funds. The same would be the B, and with a little bit less of a skew on the insurance. And the C's are, often hedge funds, sometimes equity investors that see this as an attractive alternative to equity, and high yield crossover and special situation funds. What it does, it's a product that you can go out with one issue. You can cast in it real broadly with a number of investors and bring that blended average of what we're offering inside your typical leverage loan or high yield bond issuance, which is great for a company like ours that's building fiber and building these assets that are highly marketable.
Yeah, I mean, it seems like a highly customized type of a product. Do you reach out to the market and understand what they're looking for and then build the structure around that? Or do you just intuitively know different segments of the market want different things? So this is sort of how we have to package everything up.
We had the benefit of a number of real bright banks that are developing this structure. So Goldman Sachs was our lead on the transaction. Barclays and Morgan Stanley played a role in structuring and helping us understand the marketplace. So, there is a whole group of people within some of these larger banks that deal in securitization and know the industry and know what the profile is of the investors and design the products for people like us to issue and for investors to consume that look like the other industries that I mentioned previously. So it's an application that's new to the space, not new to the industry. And, having the advice of the banks that are helping us structure and having the banks like CoBank come along and advise us on how it interacts with all of the other debt instruments that we have makes it something that for my role is pretty easy. Get a lot of bright minds in the room, and then we select through a product that actually is the right thing for Frontier. And this securitization felt like a really appropriate transaction for us and a real valuable deal for us this year.
Well, you're certainly dealing with the who's who of investment banking in the world. You got the A team there. If you had to look into your crystal ball, Jim, I mean, do you think we'll see more of this type of financing in digital infrastructure and communications? I mean, as you mentioned on the outset, this is not necessarily a new structure to financing in general, but maybe a little bit new to the communications or the digital infrastructure space. So thoughts on where you see this going over the next 3 to 5 years or so?
Yeah, I think it's a definite yes. And if you look at the trajectory of other industries that have used securitization, this is the beginning of something that I think will be an important part of capital structures of companies that are deploying fiber optic networks going forward. There is huge value in these type of networks. They're resilient. They are the best technology out there. And they are something that a lender at an investment grade level should be looking to participate in for good returns going forward. The structure allows investment grade lenders to get that priority bite at the collateral and allows us to open up the aperture on who's investing in his company, and the industry is going to be seeing the same thing. I would expect to see deals this year, deals next year, regardless of what the economic conditions are. There's a lot of development being done to upgrade the broadband services throughout the country, and smart capital will be needed to help finance that. And there will be good payoffs down the long run as consumers get good value out of those networks.
That's great. I think it's such an exciting time. I mean, there seems to be this insatiable appetite on the part of infrastructure funds and private equity sponsors to get exposure to the U.S. communications market. When you hear of small properties going on the market, and it's just this incredible bidding war. Everybody wants a piece of it. So I would imagine the interest in these types of securitization deals on the part of those investors is pretty high. So I think it's a really exciting time for operators to be able to leverage this. So
it is. And it's not just the people investing in it, it's us also. So this is a transformational time in our industry. And this is a point where people who were traditional DSL providers over copper wires and all are upgrading their networks to accommodate the demand that's out there for data transmission and the consumption of data that's going to be happening throughout the country. You see things like AI and the use of data. You see things like the progression of 4K TVs a while ago and all. There is more out there that will come, and this technology will satisfy that demand going forward. So it is a transformational time for the industry. It's a huge capital investment. It's going to be an investment that's going to pay off for decades and not only make the industry healthier, but the consumers more productive and the country more valuable as we're connected together in all different parts of the world to be able to be frontline on data transmission, analytics, and the things that make us cutting edge.
Well said. We also cover and bank the energy sector, and it's fascinating to see the forecast of energy demand from data centers over the next 5 to 10 years. It's nothing short of mind blowing. I mean, that all is tied together, right? Data centers and fiber networks and all of these great applications that are going to generate a ton of data and need low latency networks. It's, again, a super exciting time. Well, hey, look, Jim, we've covered a lot here today, which has been fantastic. But before we wrap it up, I just want to give you an opportunity to share anything that, I didn't ask that you think, we should touch on. Sort of the stage is yours.
Yeah, I appreciate the support, Jeff, in your podcast and with CoBank. Nothing else in particular from my perspective, other than just a little bit of a plug for Frontier and the strategy and the timeline that we're on. It's been a great turnaround story for us at Frontier. It's something that not only do we have a good outlook for the industry, but the company itself, I think, is in the right space with the right people. We've got a vision of building fiber, selling fiber, making a better customer experience and lowering costs. That strategy has been something we've been following for the last 2 or 3 years here with great success. The investments in securitization that lenders are making to us, people who are investing in the company, is really well received as we're out trying to deliver on our promises, and feels like we're getting real good traction on that strategy and feel real good about the things that are going on. Appreciate CoBank's support, appreciate your support, appreciate all of the support of folks that are investing in Frontier and our mission going forward.
Jim, thanks again so much for being on today. This was incredibly insightful and very much appreciated.
Great. Thanks a lot, Jeff. Appreciated being on with you.
A special thanks goes out to Jim for being on the podcast today. Securitizing assets to raise capital is not a new idea in the world of financing, but it is a relatively new one for the communications industry. Digital infrastructure assets, namely fiber and data centers, have the characteristics found in typical asset-backed offerings. They are resilient, future-proof, and offer stable cash flows. And Jim's belief that we will see more companies using this structure makes sense given the capital-intensive nature of the business and the optionality it gives CFOs. Hey, thanks for joining me today, and watch out for the next episode of the All Day Digital Podcast.
The information provided in this podcast is not intended to be investment, tax, or legal advice and should not be relied upon by listeners for such purposes. The information contained in this podcast has been compiled from what CoBank regards as reliable sources. However, CoBank does not make any representation or warranty regarding the content and disclaims any responsibility for the information, materials, third-party opinions, and data included in this podcast. In no event will CoBank be liable for any decision made or actions taken by any person or persons relying on the information contained in this podcast.